Welcome to XRP Pro Ledger, and right now, while retail investors are panic selling because Garlinghouse just confirmed the Clarity Act is delayed to the end of May and Polymarket odds have dropped to 60%, whales are doing something that should make every person selling their XRP bags today stop dead in their tracks. Over $500 million worth of XRP has been accumulated by large institutional wallets in recent weeks. Spot XRP ETFs just recorded a massive $55 million inflow in a single week. The $1.40 support level is holding like a fortress through every wave of retail fear selling. And XRP is sitting at $1.42 to $1.43 with an $88 billion market cap, securing the number 4 spot globally. This is not a market in distress, this is a market being deliberately shaken. Stay tuned until the very end of this video because I am going to reveal the exact institutional trap that Wall Street has engineered using the Clarity Act delay and why the people selling their bags today are handing their XRP directly to the entities that are going to squeeze this market in a way that most retail investors will only understand after it has already happened. Let us establish the foundation of what is actually happening right now because the surface level narrative, Clarity Act delayed, XRP down, retail disappointed, is the story Wall Street needs you to believe to execute the strategy we are going to expose in this video. Garlinghouse confirming a delay to the end of May is real. The Polymarket odds dropping to 60% are real. The price sitting at $1.42 to $1.43 instead of making new highs is real. But here is what is also real and what you are not seeing on the mainstream crypto feeds. $500 million in whale accumulation happening simultaneously with every retail capitulation dip. $55 million flowing into spot XRP ETFs in a single week at the exact moment retail sentiment is at its most negative. The $1.40 support level absorbing every wave of fear-driven selling without cracking. These two sets of facts cannot coexist in an efficient, rational market unless one of them is being manufactured. The accumulation data is organic, it is on-chain, it is verifiable, and it is undeniable. That means the fear narrative is the manufactured component, and the entity manufacturing it has a specific reason for needing retail to sell right now. The Federal Reserve's quiet confirmation of what regulators are calling existing authority for banks to use distributed ledger technology is the piece of this puzzle that most retail investors are completely missing because it happened without a press conference, without a headline, and without the kind of announcement that generates social media engagement. The Fed confirming existing authority means that US banks do not need to wait for the Clarity Act to begin integrating digital asset infrastructure into their operations. They already have the regulatory permission to do so under frameworks that have existed for years and are now being explicitly confirmed as applicable to DLT. The OCC simultaneously greenlighting crypto custody reinforces the same message from a different regulatory direction. Congress is not the gating mechanism for institutional crypto adoption. The banking regulators have already opened the door. The Clarity Act delay that is generating retail panic is a delay in legislative confirmation of something that the regulators have already operationally approved. The institutions know this. The whales accumulating $500 million of XRP know this. The retail investors selling because of the delay do not know this yet. Wall Street's dual strategy in this environment is one of the most sophisticated and coldly executed institutional plays in recent crypto market history. And understanding it in its full structure is essential for anyone who wants to be on the right side of what comes next. Morgan Stanley's advisors are publicly warning retail clients about crypto risks, generating the fear narrative that drives retail selling. Charles Schwab is simultaneously running advertising campaigns that are building their crypto product infrastructure for institutional and high net worth client deployment. BlackRock is building tokenization rails without making announcements that would move the retail market. These are not contradictory strategies from competing institutions. They are coordinated phases of a single play. Drive retail out through fear and regulatory uncertainty. Build institutional infrastructure while retail is distracted by the fear. Accumulate at suppressed prices using the $500 million whale buying that on-chain data is already showing. Then deploy the institutional products at higher prices after the legislative clarity that was always coming eventually arrives. This is the oldest play in institutional finance applied to the newest asset class, and it is working exactly as designed. The $55 million single-week ETF inflow is the data point that breaks the fear narrative completely for anyone willing to look at it clearly. ETF inflows are not retail investors buying the dip. They are registered investment advisors, institutional allocators, and high net worth clients making deliberate, compliance-approved, scheduled capital deployment decisions through regulated financial products. When $55 million flows into spot XRP ETFs in a single week during the same period that the Clarity Act delay is generating maximum retail fear, those flows are not coming from people who read the Garlinghouse delay confirmation and decided to buy anyway. They are coming from institutional mandates that were approved weeks or months ago, executed by advisors who have done the fundamental analysis and determined that the Clarity Act delay does not change the XRP investment thesis 1 basis point. $55 million in a single week of ETF inflows, layered on top of $500 million in whale on-chain accumulation, is the smart money's vote on the delay, and their vote is buy, not sell. The $1.40 support level holding through the Clarity Act delay news, through the Polymarket odds drop, through every wave of retail capitulation, is a technical signal that deserves the same weight as the on-chain accumulation data. Because what a support level tells you when it holds during maximum negative sentiment is that the buyers at that level have stronger conviction and deeper pockets than the sellers. Every retail investor who saw the Garlinghouse delay confirmation and decided to exit has had the opportunity to sell. Every retail investor who looked at the 60% Polymarket odds and decided the risk was too high has had the opportunity to exit. The price has tested $1.40 multiple times through all of that selling pressure and bounced each time. That means the entity absorbing every one of those retail sells at $1.40 is a buyer with a larger position than all of the retail sellers combined, which is exactly what $500 million in institutional accumulation looks like from the outside when you are watching the chart without the on-chain context. The IMF reserve instrument discussion that is circulating in institutional research and insider circles adds a dimension to the XRP story that goes beyond the Clarity Act entirely and explains why the institutions accumulating $500 million in recent weeks are operating on a thesis that does not depend on any specific piece of US legislation. If XRP is being positioned as a reserve instrument within IMF frameworks for cross-border settlement between central banks and the XRPL's existing relationships with central bank digital currency programs, its zero-exploit 13-year track record, and its post-quantum cryptographic upgrade timeline all point toward exactly that positioning, then the Clarity Act is not the ceiling on XRP's value. It is the floor. The Clarity Act passing would be the regulatory event that unlocks the next wave of US institutional capital. The IMF reserve instrument positioning would be the global sovereign event that unlocks the wave of international capital that dwarfs the US institutional wave entirely. The whales accumulating at $1.42 are not positioned for the Clarity Act. They are positioned for what comes after it. The tether risk dimension that sophisticated institutional analysts are tracking adds another layer to understanding why XRP's structural position is uniquely advantageous in the current market environment. Tether is the largest stablecoin by market cap, and serious concerns exist in institutional research circles about the quality and auditability of its reserve backing. A Tether reserve crisis would trigger a massive Bitcoin liquidation event as holders convert USDT positions into Bitcoin and then into fiat simultaneously, creating downward pressure across the entire crypto market. But XRP's relationship to a Tether crisis is fundamentally different from Bitcoin's because XRP's value is not derived from its role as a store of value that competes with dollar-denominated assets. It is derived from its utility as a settlement layer that becomes more valuable precisely when the dollar-denominated stablecoin infrastructure it is replacing is under stress. A Tether crisis that drives a Bitcoin sell-off could actually create the conditions for XRP to decouple as institutions searching for dollar settlement alternatives outside the compromised stablecoin infrastructure turn to RLUSD and XRP-based settlement rails instead. The $500 million in whale accumulation happening right now may be partially a bet on exactly that decoupling scenario. The mathematical structure of what the institutional accumulation data is pointing toward deserves a serious analytical treatment rather than just an aspirational price target, because the on-chain data gives us specific inputs that make the institutional squeeze thesis more than speculative. Over $500 million in whale accumulation at prices between $1.40 and $1.43. The $1.40 support holding as a fortress. Spot ETF inflows of $55 million in a single week, and $88 billion market cap at the number 4 spot. 60% of the circulating supply held near break-even, creating a resistance wall that is being systematically thinned by institutional buying. Each piece of whale accumulation at the current level reduces the available liquid supply that would need to be absorbed for the price to move to the next resistance zone. When the Clarity Act eventually passes, whether at the end of May or afterward, the institutional capital that is waiting for that specific regulatory trigger will attempt to enter a market where $500 million supply has already been removed from available liquid circulation. That supply reduction is the mathematical foundation of the squeeze thesis, and the whales building positions right now are the ones engineering it. The complete intelligence picture that emerges from all of these data points assembled together is one that retail investors watching the price action and reading the Garlinghouse delay headlines will not arrive at independently, which is precisely why the institutional strategy depends on retail not having this context. The Fed confirmed existing authority, the OCC greenlit custody, BlackRock is building tokenization rails, Morgan Stanley is deploying advisors while running fear messaging, whales accumulated $500 million, ETFs took in $55 million in a single week. The $1.40 support is holding. The IMF reserve instrument positioning is advancing in institutional research circles. The Clarity Act delay is a temporary legislative calendar event, not a fundamental change to XRP's legal status, institutional relationships, or technological positioning. The retail investors selling into this delay are giving their XRP to the exact institutional buyers who will drive the price to levels that make the current $1.42 entry look like the obvious buying, and that in hindsight everyone will claim they made. The trap is not set for XRP holders. The trap is set for the retail sellers, and Wall Street is closing it right now. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.